Chris Recker. He's the Chief Investment Officer at AZA Capital Management. Whoa, Chris, and you're down at Orlando at our Lane Conference. Good to see you again, my friend, back on the show here. So, Chris, when you're on, you've been warning us for some time about some of the bigger, longer-term risks. We're talking like decade-long risks out of China. This virus situation has got bonds inverted again. Everybody's freaking out. Is this the situation that's going to like tip the scale?
I don't know if I would go as far to say, I think it's too early to tell first if this is going to be the event that tips the scale for China. But I would note that, the Chinese PMI that came out was at a 50. And, we've been watching the China credit impulse as giving some legs to the, basically the grounding in what the turn in what we've seen in some of the macroeconomic numbers. And so this isn't going to help. And, we've seen credit growth there potentially stalled. And, this may be a tipping type thing where you have low growth, and when you have low growth, any type of shock can push you near to recession. And you go back to look at the U.S. GDP numbers, 1.3% of that came from trade. And generally, when trade is weak, or trade is good, the U.S. industrial economy is weak. So we're seeing a lot of trends, and this is a very serious event, though.
So your point here is, look, even though we were starting to see some better data, try to turn the corner, it wasn't exactly blowing the doors off, and we don't have a lot of room for error.
That's exactly right. And, we still see weakness in Europe and Japan, and especially in autos. I think that's a place that we have to look at as part of, private investment has been, basically flat year over year. We see a lot of slowing in payroll growth and wages. Those things are all precursors to what we see as we go into slowing economic growth, and those trends haven't abated yet.
Yeah. All right. Now, there's still this positioning situation that's going on, and it's wild in my eyes so far to see the way the bond market apparently is taking some logical leaps forward. Doesn't mean they'll be wrong, but Chris, over the last couple of years, I mean, stocks have had a decent record here for telling us about the shape of the economy in the sort of 6 to 10 month term. And I don't know, I've seen a lot of earnings, just all the chip makers, the bottom is in according to them. And I imagine it's going to take more than an outbreak of a virus to, grind down data center build outs and 5G stuff. I mean, how do we even come up with a way to monitor this and its impact on the economy?
Well, I don't think it's going to have any real impact on 5G investment. I think that's a trend that's in place, it's firm, and it's going to be a secular trend, at least for the next, 5-10 years. I mean, it's going to create new industries. The investment here is going to be massive, and it's going to be positive. And even if things start to shut down, I mean, you may have some drag, but I don't see anything that's going to reverse that unless there's some kind of fatal flaw in the technology. But, I would look at the industrial, consumer, parts of the economy, housing, and see how those things are affected by slowing growth. And you're going to see it, like you see it in the effects of, how long people work during the week, how much money they make. This PCE number was driven mostly by healthcare spending. And that's not, we already have too much of that in the U.S. economy. We need less of it and money going to other places. And so the stuff that's doing well are things that you don't want to see. We want to see more broader strength. And, in the S&P 500, we've maybe had 200 companies report so far, and earnings growth is maybe out of those 200 right around 3%. So it's not like, maybe the bottom's in, but this isn't a gangbusters economy, and that's the point we've been trying to make, is that lower rates are tied to lower growth. And if you look at that over the last 50 years, anytime we've had rates in this area, we've had lower growth.
Yeah.
And, that's good.
Yeah, I was just going to say 3.7% is the earnings growth right now, according to Bloomberg. Usual beat rate around 76. No surprises there. Sales growth 1.5. Again, they're not blockbuster numbers, to your point about that kind of small room for error. But a lot of this still comes back to the U.S. consumer spending. So if that's what held us together the last year, Chris, the power of Americans just blowing through their weekly checks on Lulu pants and Amazon subscriptions, but now they're buying houses too. So they're taking out more than weekly checks and putting them to work. If that's still the backbone here, should we be worried in the short term?
I don't think we need to be too worried. I would just say valuations versus growth. I think the U.S. is not, it's nearing a slower growth period. It doesn't mean we're going to be in recession. And I think to your point about housing, it is the most important thing. And housing, the volumes we've seen recovering in housing are very, very good leg of support, and it could really keep us out of recession. I think that is probably the biggest development of the bond market staying low, is that these low mortgage rates are going to continue to affect the ability of people to get houses, refi, and spend money.
Yeah. Right now, we're going to see Amazon open up above $1 trillion. I know that the bigger they get, there's always going to be some haters, Chris, that say the market's too concentrated and it's going to implode from the top down. I mean, does that make any sense? These are the companies that are changing the world.
I don't know if it's going to. Yeah, I think you make a good point. These are great companies. They're delivering tremendous performance, and are the valuations too high? On some of those, you could say, look, they're very richly priced, but I'm not a hater of any of these companies. I think they're making really rapid advances. You read about Amazon and their Amazon Web Services bringing artificial intelligence capabilities out to the edge of 5G networks. That's very interesting stuff across the spectrum. They're making investments in technology, and distribution across the board, and it's forcing other people to get better at everything. And we see Target getting better and Walmart getting better because of Amazon. So it's having an effect across the economy. Same thing with Google and Facebook. You're seeing Shopify and Trade Desk. All those types of companies, they're going to be competitive responses, and we think over time, that's going to be good for everything. But I don't know if those names are going to bring the economy down, or the market down.
Chris, on the U.S. dollar, I want to get your take on this because it's softening up again today, and almost just symbolically on Brexit Day, the fact that the pound is chipping away at the greenback here. I mean, we've come a far ways from the market thinking, I guess, that everything good is only happening in America if they're willing to rally the pound now that Brexit has come to fruition. So is the peak for the dollar's 2-year, stranglehold over currency markets over? And what does it mean if it is?
Well, I'm not convinced that it's over, because when we look at 30-year swap spreads, those markets have eased off a little bit, and so we still see a dollar shortage. And the effects are still lingering around the world. And so the dollar could be bid, and there's still a lot of debt issues, action in the repo market, which suggests that globally there's still demand for dollars. With Brexit, just having certainty there and a government that's united and moving forward, I think that's it's better for Britain. Being in lingering out there with no action on anything, it can't be good for any country. And so the pound relative to the dollar is probably deserved. But we're not convinced that, if the dollar does weaken, I will say this, we're very bullish if the dollar weakens.
Okay.
That's a sign that conditions around the world are getting better, that dollar availability is getting better. That's good for emerging markets. That's eventually good for, it's going to be good for a lot of Europe. It's going to be good for a lot of the people we trade with and our earnings in our companies.
Love that point, Chris. I think it's important one a lot of people overlook here too, are watching it like a hawk, because so far in this whole coronavirus thing, it's the only one that hasn't really had any big volatile move. It ran up, it kind of got stopped maybe where you'd expect if it's still trending lower, but dollar shortage at the moment, maybe putting the floor under it. Chris Recker, as always, really good stuff. He's the Chief Investment Officer at AZA Capital Management. There's the opening bell at the NASDAQ. We'll be back in the Orlando Link Conference. Thanks again to Chris for joining us. Really nice analysis here to kick us off.